Earning a high income is one thing, but actually keeping it? That's a whole different ballgame. Today, we're going to crack open the financial playbook of the super successful. We're going to look at 3 totally distinct levels of strategy, from building a rock-solid foundation all the way to some aggressive tax-eliminating moves that could, frankly, completely change your financial world. Does this sound familiar? You're making great money, you see that big number on your paycheck, but then, poof, a huge chunk of it just seems to vanish into thin air. It feels like this invisible expense, right? Well, for most high earners, that invisible phantom has a name, and it's called taxes. And we're not talking about a small amount here. For people at the top, especially if you live in a high-tax state like New York or California, your combined federal and state tax bill can actually creep up to almost 50%. I mean, think about that for a second. For every $2 you make, $1 could be going straight to the government. That's a massive, massive headwind when you're trying to build real wealth. So here's our game plan. First, we're going to really define this core problem high earners face. Then we'll walk through 3 completely different playbooks: the absolute essentials for your foundation, the strategies to accelerate your growth, and finally, the aggressive plays designed to just wipe out your taxes. By the end of all this, you'll have a much clearer picture of which path might be the right one for you. You see, for most people, the biggest line item in their budget is their mortgage or rent. But once you hit a certain income level, the rules of the game just completely change. Your single biggest expense by a long shot becomes taxes. And if you can get a handle on that one thing, that's where you unlock some serious wealth creation. All right, let's start at level 1, the foundation. Now, this isn't about finding some crazy exotic loophole. This is about building a financial base that is absolutely rock solid. These are the steps that are pretty much non-negotiable for any high earner. So here's that foundational checklist. First up, you've got to have an emergency fund. We're talking 3 to 6 months of your living expenses sitting in a safe, high-yield savings account. That's your buffer. Next, you max out your health savings account, or HSA. And trust me, we're going to see why this thing is so powerful in just a second. And third, you put the absolute maximum you can into your 401k or whatever retirement plan your employer offers. You have to take advantage of that tax-deferred growth. Okay, let's zoom in on that HSA, because honestly, it's like a financial superpower. It has this incredible triple tax benefit that you just don't find anywhere else. So 1, the money you put in is tax deductible today. 2, you can invest that money and it grows completely 100% tax-free. And 3, when you take it out for medical expenses, it's also tax-free. It's the only account that does all 3. It's just amazing. Oh, and one more thing on the foundation, and this is crucial. If your job offers a 401k match, you have to contribute enough to get every single penny of that match. If you don't, you are literally just turning down free money. It is the best, most guaranteed return on investment you will ever find. Period. Okay, so once you've got that solid foundation built, you're ready to move up to level 2. This is all about accelerating your wealth. This is where we start talking about the more advanced tools that can really help your money grow in a tax-smart way. Now, a really big decision you have to make here is whether to go traditional or Roth with your retirement savings. So think of it this way. With traditional, you get your tax break right now, which is great, but you'll pay taxes when you pull the money out in retirement. With a Roth, you pay the taxes up front today, but then all your growth and all your withdrawals in retirement are completely tax-free. A lot of high earners lean towards traditional because it lowers their big tax bill during their peak earning years. And beyond the basics, there are some really powerful tools out there for high earners. You've got the backdoor Roth IRA, which is a clever way to get money into a Roth, even if your income is technically too high. Then there's the mega backdoor Roth. If your 401k plan allows for it, you can sock away a ton of extra after-tax money. And for business owners, something called a cash balance plan can let you make these huge 6-figure pre-tax contributions. It's kind of like a pension plan on steroids. So what happens after you've maxed out all those fancy tax-advantaged accounts? Well, then you move on to a regular old taxable brokerage account. And in here, the name of the game is being as tax efficient as possible. You do that by sticking to things like low-cost index funds and, crucially, holding your investments for more than a year. That way, you get taxed at the much lower long-term capital gains rate. Okay, now I need you to buckle up because we're about to shift gears in a really big way. Level 3, this is not just the next step up, this is a totally different way of thinking. This is the aggressive playbook, championed by people like Grant Cardone. And the goal isn't just to lower your taxes. The goal is to wipe them out completely. And I'm not exaggerating. The goal here is ambitious, it's provocative, it's to get your tax bill on your earned income all the way down to 0. We're not talking about saving a few percent here and there. We're talking about a fundamental re-engineering of your entire financial life. So the philosophy behind this is actually pretty simple, but it is radical. Here it is. Stop thinking of your salary as something you spend. Instead, you treat every single dollar you earn as investment capital. The goal is to immediately plow that money into assets that give you massive tax write-offs, which in turn drives your taxable income down towards zero. And the main way to do this is with leveraged real estate. So here's how it works in a nutshell. Step 1, you take your income and invest it in a property. Step 2, you use debt, a loan, to buy a much, much bigger property. Then, step 3, you use a special tax rule called accelerated depreciation, which lets you create a huge paper loss. Now, this isn't you actually losing money, but for tax purposes, the IRS says it's a loss. And then, step 4, you use that giant paper loss to cancel out your real earned income. And to see just how powerful this can be, look at these numbers. An investor takes $1.6 million of income, uses it to get a loan, and buy a $4.8 million property. And in that very first year, they could generate a $2.4 million depreciation write-off. That's more than enough to completely erase their $1.6 million in taxable income. It's just gone. But the real endgame here isn't just a one-time tax trick. The goal is to build up a whole portfolio of properties that are generating passive income from rent. And then, years later, instead of selling the properties and paying a huge capital gains tax, you just borrow against them. And the money you get from that loan, it comes to you completely tax-free. Now, obviously, this path is not for the faint of heart. It's complex, it relies heavily on debt, but for some people, the potential payoff is just enormous. So we've walked through 3 very different financial playbooks. We have this solid foundation, the path for accelerated growth, and that really aggressive strategy for tax elimination. So now the big question is, which one of these approaches actually makes sense for you? This chart really lays it all out. You've got the foundation level, low risk, its main goal is stability, and you're using tools like your 401k and HSA. Then you've got the acceleration level, medium risk, you're focused on tax-efficient growth with things like the backdoor Roth. And finally, the aggressive level, high risk, using leveraged real estate with that audacious goal of eliminating taxes. And here is maybe the most important takeaway of all this. There is no single best strategy. There just isn't. Your perfect path depends entirely on your own financial situation, your goals for the future, and maybe most importantly, your personal comfort with taking on risk. What's right for a real estate mogul could be a complete disaster for a surgeon who just wants a stable retirement. So you've seen the map. You have the foundational path, you have the accelerator lane, and you have that aggressive, high-risk route. The question now isn't just which one you'll choose, it's what's the very first step you're going to take to start writing your own financial future.